We also want to talk about Nike shares falling this morning after announcing a plan to cut $2 billion in costs and announcing that they're wading through a more difficult consumer environment. This all coming during its second quarter earnings call Thursday night. The sneaker giant just missed analysts' expectations for revenue, but beat on adjusted earnings per share during the quarter. Diving into this report, we had a few key takeaways, Shauna, and the softness in digital traffic is one that really caught my attention here as the company was talking about it on the call, and we'll run through the other two as well in just a moment. But on that softness in consumer traffic, they mentioned on the call that while Nike store traffic continued to grow, we saw softness in digital traffic and higher levels of promotional activity across the marketplace.
Yeah, promotional activity, that was the second thing we also wanted to talk about, but it all ties together, right? It comes back to the fact that the consumer is weakening a bit. They're being a little bit more hesitant in terms of making those big purchases. We certainly did see that reflected in the digital sales number, a rise of just about 4% compared to what we saw a year ago, which was a jump of 25%. So we got to put that in perspective. What I'm really focusing on, though, is the hunt for deals, because this is a theme that we have seen now throughout this earnings season when it comes to these retailers, when it comes to consumer behavior. On the earnings call, company executives saying that there are indications of a more cautious consumer behavior, not just in the U.S., but what we're seeing around the world. And I bring this up because I also want to show two charts that Goldman Sachs was out with this morning, talking about, and I think it really points to the weakening that we're seeing in the consumer. One of those charts was delinquency rates, how we are starting to see a bit of a rise. We do expect that here to continue to be at elevated levels. You can certainly see it tick up just a bit, and it's projecting out to 2025. The second one is the rise that we are seeing when it comes to rates and higher interest rate payments for credit cards. So you see the commercial banks of credit card interest rates there rising, having that uptick. And I bring this up because that is just illustrates the pressure that so many consumers are under right now. If they're not able to meet those credit card payments, the interest that they are being charged, obviously just another layer of the complexity and another layer of pressure that people are feeling at this point.
Absolutely. And then the last thing in our key takeaways here was really what's set to come in some of the inventory mix shifts here. And what do we mean by that? Well, they're going to lean more into, and especially kind of looking across the brands that have performed best for them. You think about the Jordan brand and how they've essentially been able to expand that into everything that is even non-basketball at this point. You've seen it on the soccer pitch, you've seen it on the football field, you've seen it on the golf courses. And so all of that considered, they mentioned their top franchises continue to drive strong full price sales, but intentionally managing the life cycle of these models across the marketplace for long-term value is what's important to the brand. So given the promotional environment and plus the cautious consumer behavior that you were outlining as well, showing up in that transaction data, they're going to be stepping up plans to reduce marketplace supply of some of their key franchises, and that's where it comes into an inventory management mechanism as well here.